Monday, April 16th, and I've got some, I want to keep this real short, and I want to show you what I did really first thing this morning. It's quick and dirty. I want you to learn this quick little strategy here, okay? Look at the market opened up higher, right, from Friday. Let me just show you here. Market closed right down here on Friday, opened up considerably, took out the 200 exponential average, okay, on the open. So what I look to do here in the first 9 minutes at times is this. When the market comes up and touches one of my pivot numbers, hit the daily R1 at 1375 and a quarter, right, round down to a quarter. Market, that first bar of the day traded up. This is a 3-minute bar of the E-Mini S&P 500. Traded up, closed at the top of that range. The next bar opened in the, I would say in the bottom third of that range, traded up to 1375 and a quarter and closed in the bottom quarter of that range. A very low risk trade is on the following bar. On the first bar that turned green, I'm looking to go short as the market takes out that second bar's low with an initial stop loss directly above the high of the high bar. So it's a three bar trade here. Let me move this out so it's easier to see for it here. Let's see. Yeah, okay, look, I had some fibs up as well. I wanted to know where the fibs were. I measured from Friday's high to Friday's low, right? Measured from the high to the low. 60% retracement was right up in here. So again, let me outline this trade again. Look at this. All right. So basically the market opened up higher, right? That first bar of the day was bullish, closing the top, right, on the very high of that bar at 1374 and a quarter. The next bar traded up and hit the daily R1, right, at 1375 and a quarter. Hit 75 and a quarter. And what made this trade set up was the bar that actually nailed the R1. Okay, look at the bar. It opened up in the bottom third of that bar, traded all the way up to 75 and a quarter, and then ended up closing on that bar at 74 with the low was 73 and 3/4. So I call that a bearish blow-off bar. So what set this trade up was this third bar. The first bar that turned green, okay, was when it closed, when it took out the prior bar's low of 1373 and 3/4 and went down to 73 and a half. That's when I was going short automatically, is it penetrated down through the prior bar's low of 73 and 3/4 with a buy stop at 75 and 3/4. Okay. Very, very low risk trade as the second bar's low is broken to the downside, go short with an initial stop loss above the high of that second bar, looking for the market to continue moving down. And you saw the second bar that you were in right here close lower, and you started to come back down and break down through this support level, these support levels down here, using a trailing stop. Okay, the trailing stop that I typically use on something like this is above the prior bar's high. So right here is when I got stopped out, when it took out this bar's high right there, the high of 1368 and 3/4. Okay, I actually had my stop at 69 and a quarter, went to 68 and 3/4, or went to 69 and came down, never took you out there. And then on this bar, look at this, 67 and 3/4, so 68 and a quarter would have been a buy stop, went to 68. Remember, I always talk about never ever stopping yourself out at rounds and halves. So as you're trailing, as the market's moving lower, if you move your stop down to above the prior bar's high, right, and that happens to fall on a round or a half, you would want to go up. So again, look at one tick above, 67 and 3/4 would be 68. So you go 68 and a quarter above that round number of 68 even. It stopped at 68 and you're down, and we're still short this market right here. So that's a beautiful, beautiful, like what I like to call an out of the gate type of trade. Got you in the first 9 minutes, before 9 minutes. So you had the first two bars that set it up, and then that third bar, as it reversed and took out the middle bar's low, that's when you're going short with a stop above the high of that second bar. The market continued dropping, broke down through the 200, the gray action zone, the 50, traded down right through the daily pivot at 69 and a half as well, and then just trailed us down. So right now, the buy stop on this is 64 and a quarter, above the high of the prior bar's high, right? Last bar's high is 63 3/4. One tick above it, 64, so it would be 64 1/4. And that's from a short, okay? Remember, we shorted the market as it took out the low of the second bar's low, right? 1, 2, took out that low with the stop right above that high. Okay, so again, as the market took out the low of 73 3/4, sell it at the market. Now remember, I didn't have an automatic sell stop below that because one tick below 73 3/4 is 73 1/2, and I don't want to sell at 73 1/2. So I'll just sell it at the market as it penetrates down through 73 3/4, hoping that I might get a higher price, right? Because if it ticks up from as it's going down through 73 3/4, if I hit the sell button and it goes up a little bit like a tick, I might get a better fill. But in this particular case, quite honestly, they fill me right at 73 1/2. So no big deal. 73 1/2 was the short with the buy stop at 75 3/4. Okay, so still in this trade right here with the buy stop up at 64 1/4, and I'm going to end the video. It's a little long. Hope that helps. Hope you have a great day. And if you've got any questions, let me know. Bye for now.